G'day, I'm Nick from YourQS and welcome to Beyond the Guesstimate, our podcast where we explore ideas around construction, cost-informing design, so how cost, design, building all tie in together, and looking to talk to interesting people about issues in our industry and come up with some ideas of how things could be done better. In the last couple of episodes, well, a recent couple of episodes, we talked to some builders, so Brent Chatterton from Chatterton Homes, and Anthony Kane from Kane Group. And one of the common themes with it is around managing the cost of projects, managing the margin in your business, and trying to ensure that you've got a profitable business. So what I thought would be good would be get somebody in who really knows about that sort of stuff. So I got an accountant in. So we can just drill into that in a bit more detail. One of the things I often talk to my customers, or one of the things I often get asked from customers is sort of how much margin should I be sticking on? How much markup should I be applying? And a lot of them say, is 10% enough? And I say, well, 10%, you've got yourself a job, you haven't got yourself a business. So I certainly don't think 10% is enough. And when you look at the sort of whole process, one of the things that both Brent and Anthony commented on is having a good estimate to start with. So having a credible budget to start working with is important, but then also tracking the costs through the project is important. So we'll start getting today, we've got Tim Fleming from Tim Fleming Associates in with us, and we'll start drilling into this in a bit more detail with Tim. So Tim, I know QSs are boring, but accountants? What the hell made you want to get into accountancy?
To be fair, I had no real clue about what to do, and my girlfriend suggested I didn't get into accounting. She was just completing her accountancy at the time, and that was kind of like one of those opportunities to push back a bit against it, But prior to that, I'd actually done an engineering apprenticeship, a tool making apprenticeship. Yeah, and I thoroughly enjoyed the concept and working with my hands, but it really didn't take my brain deep enough. So I jumped into accounting. It was a bit of a fluke and just loved it, to be honest.
Okay.
Yeah, absolutely. I use my engineering concepts around systems and structures in accounting because it is very much a structured situation. And then I moved that out to my view of business. And, business really is a set of concepts, a set of rules, an environment. A lot of those things change, right? We've got all sorts of variables changing all the time, and that's part of the business owner's job is to understand what's going to change in their business. But, one of my fundamentals is that I am working to help people make better informed decisions. So I'm trying to empower them. And one of the very first ways that I work is I get the person to dream their dream, to think forward, whether that's a 5-year plan or whatever. Dream what the business should be like then, and then reverse engineer it to where it is today and think about the steps we've got to do to build the outcome.
So how long have you had your practice, the Tim Fleming Associates?
As an individual practice, it's now 27 years. Yeah. Been in accounting for 40. I started studying in 1985. Yeah. So I only did 4 years in tool making, so I don't consider myself to truly be an engineer.
Yeah, right. Did you complete your apprenticeship? Or?
Yeah.
Okay.
Yeah, absolutely. Yeah. Moved on the following year.
Okay.
Yeah.
And so your journey into accounting then, you studied, did you work for other people or did you do your own thing pretty early?
Yeah, look, I had some real opportunities and I fluked into them. I started studying full-time and I did my first year and I applied for a part-time accounting job in a small, very entrepreneurial accounting firm in Queen Street. And that then morphed into another little quite entrepreneurial firm. And so I learned from the beginning, this isn't just about being a clerk and doing tax returns. This is about real people, real situations. We had people going through the 87 crash. So they were up against the wall. What can we do to help them to trade out or help them into, a less painful liquidation or whatever? So I was very much working with the real world. I was associated with a very small association as an accountant with a company that went public in the pre-87 crash, and lasted about 6 months post-crash. So I saw all of that going on as well. And fortunately, it wasn't me spending the money in the share market. I saw others doing that. But yeah, no, it was a great expose into business.
Right.
Yeah.
Right. So you touched before on about people's dreams, and I guess the underlying reason why a lot of us get into business is to be able to live out our dreams, or to be able to fund our dreams.
Yep.
And to do that, we need to have profitable businesses. So the idea of profit, when somebody talks about profit, what does it mean to you, and what's important about profit in a business?
Right. So, I'm going to look at that from 2 points of view, the physical kind of profit, and the other thing is, why are we in business? So before the physical profit, we're using our business to fund our life, but the reality is it's a major component of our life. So for me, it's about finding our freedom, our growth, our joy in business, right? So it's not just something we go to. And if you can get that, then you can see some of that as profit, right? From an abundance point of view, But if you look at real profit, the building industry is pretty unique, pretty scary when you think about it. There's a lot of things going on. So from a profit point of view, my very first step is gross profit on job, right? Looking at it on a job-by-job basis. Are we making profits, gross profits? Can we learn from our mistakes? And that's then about systems and all of that. We can get into that. But then gross profit across multiple jobs. Are we consistent in being able to make a profit, right? And then I've got a whole pile of overheads to take off of that net profit. What am I truly taking home? Is that before I pay myself or after I pay myself? Small business, big business, different sort of attitudes. And how much have I got invested in the business, and am I getting a return from that investment? So we can break it out into fundamental steps. We don't need to break out the humanity from it, right? It's important to get a return on our efforts being paid for it. It's important to get a return on our assets, on our risk. And by understanding that, we can then work out whether our business is performing or not.
So I guess the level of profit that businesses expect, or the level of returns, changes in the different circumstances. And so in the building industry, we have, I guess, typically two types of contract: fixed price contracts, or charge-up contracts. Yep. How would you think they should be treated, and should they be treated differently from a profit perspective? And businesses entering into those different ones, what sort of things should they be considering when they're thinking about their profits? Yeah,
absolutely. So, fundamentally, those two different approaches, fixed price versus charge-up, should really be seen as tools to use in an environment. So you can imagine that, with the massive changes to pricing over COVID, there was very much a desire to move towards charge up to avoid the risk of the fixed price changes. You tend to looking in from the outside, I would tend to look at charge up as being the real value add, the boutique sort of value, rather than just fixed price and taking a risk. So you've got to respond to the environment and make those right calls. But you can imagine, even with fixed price, there'll be work on special clauses these days to try to avoid some of that fixed price risk.
I guess, you touched on the COVID thing. That was an unprecedented time of price increases for most people in the industry. You and I are obviously old enough to remember the days of inflation. And so price escalation was sort of an everyday part of doing business back then. Yeah. But for most, a lot of people's careers, they wouldn't really have struck it. And then suddenly 2020 struck, and we were back into these sort of escalation areas. So a lot of businesses that would have had fixed price contracts that may not have had an escalation clause built into them, potentially were getting caught through it. So that shows that there's a different level of risk on them. So would you expect people to be making a different level of profit depending on that? So if you're going fixed price, you should be making a higher return than what you would be if you're, say, doing charge up?
Yeah, absolutely. You've got to build in your protection, your risk protection, right? So that suggests a much higher markup on a fixed price. And that then takes you into, you've got to do your due diligence, right? So that's about, do you have good systems to track your costs? Are you using a QS to, lock in that fixed price area? Do you have systems and history that you can rely on that suggest you're good at what you're doing? That's the thing I think is fixed prices. It's a major danger, and if you're a newbie, you're going to get burned.
But I guess from the other side, that, and in terms of a builder, if they're offering fixed price, then that's a value add from the client's point of view because they're getting some more certainty around it. So it's not that we're anti-fixed price. It's just you've got to be aware of what you're going into and making sure you've got your ducks in a row, making sure you're confident with your business processes to support that market offer that you're making of fixed price. And if you're capable of doing that, you should make good returns from it would be my view on it.
Yeah, absolutely. And that's a really good thing to remember is that, it's a two-way street, right? You're looking at it, if we're looking at it from the builder's point of view, trying to mitigate risk, the client's looking at it from a point of view of certainty, and that fixed price gives them certainty. They will pay a margin for certainty.
They should, yeah.
They should. And also that often builds into banking too, right? If the client needs banking to fund it, banks almost certainly going to require fixed price, right?
Yeah.
So that's your opportunity as a builder to fit in appropriately with the client and create a product pricing situation that works for both of you.
So before you touched on overheads, and so there's something we're aware of as QSs, and for us there's sort of two broad groups. There's the on-site overheads and off-site overheads. What we try and do is build in the on-site overheads into the project price so that the markup's applied to that. So the project's profitability is basically that project's looking after itself. And then the off-site overheads are the sort of costs of running a business that can't be attributed to any particular project. I guess what's your view of what should be in which of those two camps, or do you agree with those two camps to start with? And because it's just my theory on it.
Right.
And so do you agree with that split? And then what sort of things, where do you think things should sit?
Yeah. So from an accounting kind of technical point of view, we really look at those on-site overheads and say, well, if the job wasn't there, you wouldn't have those overheads. So it's connected to the job, right? You could kind of backtrack a little bit and go, well, but what about the portable office?
Or the ute or,
well, the ute and things, I tend to see those as capitalised costs, and I'll come back to why. But the on-site overheads, no, I see those as job expense. And so you really want to measure your job profit after having paid those on-sites. Yeah.
So basically a cost that's going to incur because you're doing that job. If you weren't doing that job, the cost wouldn't be there. So they should all be in the bucket of job costs, and you should be applying your profit to those numbers.
To those numbers. Yeah. That certainly would be my view. At the end of the day, we then have to talk about what level of margin you want to apply to it, right? And that one, if you think about that one, that's more of a bigger plan across the projected profitability for the business, which is going to take in the overheads. It's going to take in your salary, the builder's, or the owner's salary, right? If you think about that, understanding what that emerging profitability could be or should be helps you to reverse engineer what your markup should be, right? So that's from a technical kind of accounting outcome point of view. Then you talk to the marketers and the salespeople, and they're talking about, well, what will the market allow in terms of the pricing? And you've got to be aware of that, right? Because if you're just charging based on technicals, I always charge a markup of, you miss opportunities. And those opportunities could be increased profitability, or it could be you're actually losing jobs because your markup's a bit too high, right? Either way. So it's deeper into your understanding of what you want to achieve in your business and then applying it.
Yeah, I did pick up exactly on what you're saying. We worked with a really brave customer in Wellington a few years ago, and they were already applying what was a pretty high markup for the industry, something like 35%. And we just kept playing with it. And I think now they're at over 50%.
Right.
And because he was saying, I'm working really hard and I'm not really making a decent amount of return for the effort we're putting in. I think his business was sort of 2 or 3 million a year.
Yeah.
And he was thinking, for the amount of work and the risk I'm taking, it's just not giving the return. So what happens if I stick my price up?
Yeah.
And they had a really good sales process and it stuck. I'm sure they lose some jobs on price as a result, but the ones they win are enough to keep the business in a pretty good state, and they make decent money when they do it.
Yep.
And so that's exactly what you're touching on, is basically they pushed it until the market said no.
Yep.
But if you never do that, if you just say, I'm going to stick 15 on or 20 on or whatever, and you never test it, like I say, there could be dollars on the table that you're not benefiting from.
Absolutely. And that means that you're missing an understanding of the fullness of the business, and you're working in isolation. Well, I'm not trying to turn everybody into an entrepreneur, but, the ability to rise above it, take a helicopter view and understand your stake in the environment and other holders will help you to have the trust to change your pricing models, right? So many of us are kind of limited, not only by this is the way we've done it in the past, but I'm scared of changing. What if, So that's where the accountant kind of can help by helping with modelling, with understanding, kind of what ifs. For example, if you think about it from the point of view, if we were to increase our profit, our margin by 10%, this is the outcome. How many jobs would we need to lose in order to destroy that gross profit outcome? You start to get a sense of the safety of the change, But again, you set these new ideas up, these new ways of going, but don't fall asleep. Because the
market changes.
Changing.
You might have, my mate in Wellington might have been able to get away with 53%. Maybe you can't in the current market. I don't know. You've got to stay in touch. And it's interesting. I started off my career, but like you, in engineering, not tool making, but engineering, and got into engineering sales really early on and got a lot of sales training. And I remember a lot of that sales training was, it's not about price. And I struggled to believe it. I always felt it was about price. And sort of, I guess, as my 40 years of experience now in business, I've sort of realised that it really isn't, that people often use price as the reason why they're not dealing with you, because it's an easy one to say and it sort of justifies everything. But in reality, it's more complicated than that. More often than not, it'll be something else other than price, and they're just using price as the reason. That's it. But it's just interesting through this conversation with you, sort of realising your sales process and your profitability are actually tied together. And now I've got the view that if I miss a job on price, it's because I haven't done a good enough job of selling them why we're good.
Right.
And why we're good is because we put a lot of time and effort into making sure we're as good and at the best we possibly can be. So I've got confidence in the product or the service that we offer, that it's worth the price that we're looking to try and charge for it.
Yep.
So that to me comes back to, if my price is too high, it's a sales issue, not a price issue.
Right.
And and now I'm sort of realising just through this conversation, so this is enlightening for me as well, is that then that ties into the profit, that if you do a good job of that, then the whole thing's sort of almost one big bundle. A good sales process gives you the ability to be able to charge a higher margin, which then ultimately ends up in a more profitable business.
Absolutely. And, if you think about that sales process, you're getting to know the customer, right? And some customers are going to be dangerous, and some customers are going to be safe to work with. Well, that's part of your sales process, is to understand that. Now, one of the things there is that, so we've got our contracts, right? We've got the Construction Contracts Act and all that sort of stuff. Those contracts are templates. They're a starting point. Good stuff, but a starting point. So if you're dealing with a difficult customer that you ultimately don't trust, you might choose not to do the job, or you might choose to do the job, but let's add in a few special clauses to protect us, If you think, for example, that they're going to run away from the last invoice, you might put some security in place or something like that. And that then helps you to kind of moderate your view in your business without just simply going, well, I need the job, I'm just going to suck it and see. I'll sign on for the risk, So we have to be very interactive with our business.
Yeah, so like you say, just doing things by rote, doing what you've always done is Yeah, danger. Yeah, so I guess somewhat of a recipe to disaster, but probably a recipe to underperforming as a business.
Absolutely.
So you may be avoiding disaster and you may be surviving through it, but if you're investing, like I've done, invested my life in my business, if you're investing that much into it, you really want to make sure it's worthwhile, and just turning up every day and running on the rabbit wheel or whatever it is, is not necessarily going to get the best outcome from what you're putting into it.
No, exactly. And that's the thing, right? So you've just described the passion in business. You've got the passion for your business. Builders have passion for their business, for their product, Don't forget to sell that passion, right? The owner, this is where the builder needs to be involved in that sales process. The owner, they're about to have a house built. It's a major investment. If they can see the passion behind the person who's delivering that, that's part of the sales process. Absolutely.
So before we came on here, I stopped you in the middle of a conversation because I thought it was really good and worth having while we're on air, so that everybody can benefit from us having this conversation. And it's something I've been putting a bit of thought into recently is I think the building industry is particularly challenging with the whole boom bust thing, and managing a business through that and making sure that we're able to survive through those periods and be able to respond to it is an important part. So I guess, how does all of that fit in, and sort of, can you carry on with what you were talking about before?
Yeah. Well, I mean, it's a really big subject, right? What you're really talking about is you're involved in business and things are going not quite the right way. Do you get clammed up by fear? Do you start speaking to your advisors and your trusted people around you? So, to me, it's about opening up and speaking to your trusted advisors. The thing with anything, a business that goes wrong, especially building businesses where you've got long contracts, if you don't have good accounting systems, you don't really know you're going wrong until the end. And, we've seen this time and time again where people will take a bad project and they'll roll it into the next project to pay out the bad project, and you're just chasing your tail. Whereas if you've got reasonably good accounting systems, they don't have to be that strong. Just, really basically it's project tracking more than anything else. You'll get a sense of, we're going other than to budget. Because think about this and come back to a job-by-job basis, right? We've got our budget because the QS has given us our budget. We just got to apply that to our different lines within the chart of accounts, basically, right? And, if it's going against it, inquire. Now, it could be as simple as, we paid for it this month instead of next month. Well, great, move on. But if we're putting in double the labour that we've budgeted for, we've got to try and work out how to resolve that, how to jump ahead, And that's then the moment where pretty much every business person has to attempt the entrepreneurial kind of steps. The what ifs and how do I make lemonade out of this lemon, And the reality is that there are a lot of clever people around that they can call on. Good accountants, good lawyers, good other colleagues in the industry, right? Yeah,
there's professional builder organisations, certified builders or master builders, those sorts of people.
Yeah, and I would imagine that they probably have mentoring processes as well, right? If you get yourself into some real cactus, they'll probably find somebody who knows that flavour of cactus, put them alongside, I've done this before, this is the way out.
So in terms of the tracking the job, it sounds like you're saying you're not necessarily counting every nail that's gone into it, but sort of having reasonably broad buckets that you're keeping an eye on. Yep. And if one of those buckets is way too low or way too full, then you start spending some time figuring out what's going wrong with that. So you're not spending hours and hours and hours trying to get every detail absolutely perfect. You're looking for the big signals.
Looking for the big signals, right? But, if you start with where's our best basis on which to measure against, well, it's going to be something like a QSing process, right? This is what we expect of the basic build costs. Well, they're your buckets.
Yeah.
You can sub out some of those buckets if you want, but don't start doing your own thing, if you know what I mean. Those buckets are pretty standard. And so that helps you to build a reliable reporting process. For example, so what's the labour percentage in this job? Well, I would expect it to be similar in the next job. Or, well, that next job's much more technically difficult. I'm expecting another 10%. You've now got something to base it on. Then, it's about recognising when those things go a little bit awry. You've got to get the measure right. Okay, there's paralysis by analysis.
Yeah.
Just like, you're driving your car, you don't focus 6 feet in front, you've got to focus ahead. So forget the number of nails that went into that job. But, the number of labour hours, that's pretty important. But then...
And maybe the hardware or the merchant materials or whatever is a bucket. It's important exactly where it went. Yeah. It doesn't really matter until there's a problem,
Well, yes and no, yeah. In kind of refining that, there are always some decisions that the builder can use about, I'm going to use this supply rather than this supply. There are other ones where they're forced or guided, right? The architect specifies, etc. Understanding those different suppliers can definitely change your profitability, but also can send you off into unreliability, right? So if you start swapping stuff out that's going to end up with a warranty claim, was it worth it? So, and then obviously, within that, certainly on a fixed price, you do have the point where you need to start recognising, there's a variation coming up, so you get into that change situation and a change to budget. And of course, if you're too busy and you miss those variations, that's going to cost you a fortune, And that's the potential for a difficult conversation too, isn't it? Well, you've got to have the difficult conversation. I'm sorry, but this is a variation. We do not expect this. This is the outcome. Are you willing to sign up for this change in price? Yeah.
So in terms of tracking the progress through the bill, what sort of frequency do you think makes sense? So is a monthly exercise, a weekly, a daily?
Yeah, no, she's definitely a monthly. I think if it's an enormous organisation, you could get into weekly or daily, but absolutely not within most businesses. It's monthly. Some of those things are because, we get our measurement around month end. Yep. Some of those things are then also, we don't need to be concerned about, this is a 5-week month for wages. Next one's a 4-week month. Right? So no, it's just monthly. And pretty simple, not hugely complex stuff. Not for a smallish business.
Yeah. So coming back to assets that are involved in the business, so things like plant, equipment, vehicles, that sort of thing. How would you see the cost of those being recovered through the business?
So, if you have things like consumables that just chunk out in a job, right? They're just going to be costs to the job, easy. If it's an asset like a ute, for example, that's going to last for years and might be used across multiple jobs, the accounting technique behind it really is to say, no, it's nothing to do with the job, that's to do with overhead, right? That's to run the staff around, that's to run the sales rep around, whatever it happens to be. And so that ends up into overheads as a depreciation. That's your asset just being eaten up over a number of years based on the rules. And that's the best sort of matching thing that we can do. But to put it to the job, if you're truly understanding this is the answer really, if you're truly understanding your position as far as what you can charge in the market, having that overhead attached to that job's irrelevant.
Yeah.
Because you're already charging it.
Yeah, it's either in the profit or in the job.
Yeah. Yeah.
So I guess that comes back to your what you commented on earlier about having that sort of longer term view of your business.
Yep.
And if you've got an asset that lasts 5 years, then you've got to look at what the cost is of that asset over that 5 years, and is the profit you're making enough to cover
the replacement of that every 5 years.
Yeah, or whatever it is, yeah.
Yep.
So you can't just purely look at the profit job by job and say, is this enough or not? Because if you're only doing one job and you've gone and bought a flash ute, you may never pay for the flash ute off the one job. Totally. So you've got to have an expectation of, okay, I'm going to do 10 jobs this year, and the profit on those 10 jobs is going to pay for my ute. Yep. So you've got to be able to take that longer term view as well as the sort of job by job perspective.
Absolutely. Yeah, and the reality is profits in the long-term view, right? If we just focus on the short-term view and think that we're making profit, I've got a gross profit out of this job of 100K. What does that really mean?
Yeah.
If it cost me 90K to run the office. So it's understanding what impacts on your business and also what you can then influence on those impacts.
Yeah, and I guess you're sort of touching on this up and down in the business in the industry as well, is that if you've got that longer term view and you can see the industry's turning to a downturn, and you've got overheads that require you to be at this level, and it looks like it's going to be going to that level, then you've got a bit of thinking to do as to what do you do.
Absolutely.
And you've got to be taking that view to be able to see that coming. Otherwise, you end up in the middle of it, and it's pretty much too late by then.
Absolutely, yeah. We saw a really unique situation with COVID, right? Where all of a sudden we're looming up to a lockdown, and the government's doing everything it can to keep us employing people to get through. So what that did was that stopped that shedding. There were a lot of firms that shed staff, but to a certain extent it stopped a major fallout from that, through that shedding. But, if your business is independently being impacted through something, you're not performing, or the industry's having a difficulty, you've got to have that moment of going, we better sell down some of the fleet. We may need to lay off some of the core staff to get through. Painful decisions, right? But the more holistically you see your business, the more you can arrive at those painful decisions and make choices earlier, rather than, I don't know about you, but certainly for me, the worry about business decisions in the past, I've worked out how to not worry too much, but in the past, that slowed up those decisions to make changes. And that costs.
We had a tough year in 23 when that was sort of the beginning of the decline after COVID, and in some ways I could say I was a bit late. We ended up having to lay off 3 staff in the middle of 23, and that sort of right-sized us for 24. So 24 we were sort of okay. 25 I'm hoping it's going to come up a bit, so make it all worthwhile. If we'd made the decision sooner, it would have definitely helped the bottom line. But at least I was aware of it, and I made a conscious decision. We looked to open in Australia with the idea that it would offset New Zealand slowing down. Well, Australia just took a bit longer to get rolling, so that sort of didn't quite balance out as I was hoping. But I guess I made a conscious decision, and I knew it was coming, and I knew the risk I was taking with that decision. And if it all panned out well, then I wouldn't have to lay anybody off. It didn't pan out as I'd hoped, so I had to. But like I say, there was quite a bit of heartache, and it's not something you want to go through. But it's if I want to survive as a business, you sometimes have to make those sort of tough calls.
And that's the thing, right? This isn't just about moving resources around and kicking them off the board. This is humans, and so we know that has real impact, and so the better we can get at making our assessment. And even if that is, hey, look, I'm going to continue for a while. I'm not going to lay these people off. You can then have comfort in your decision. And your decision, you don't win or lose based on what profit you made last year. You win or lose based on how enjoyable life is, right? So it's getting it in focus.
In balance, So we talked a bit about sort of things from a builder's perspective. So we're a service business, and like you are. So what's different with service businesses? What would you recommend people think about differently compared to, say, something like a builder, where we've sort of focused a bit of our examples around?
So, what that is that you have a different model as far as overhead costs and direct costs go, right? And so the direct costs are really labour oriented, they're not materials oriented. You have less concern about things like carrying and losing materials. So, the emphasis changes somewhat. But if you really look at it from a projection of profitability point of view, you're still going to come up with a very similar concept of I have direct costs and I have overheads. And the fundamental there really is, the overheads are designed to deliver a certain size of business. So is my business at that size? Should I adjust my overheads up or down? And then if it's delivering that size of business, it's therefore getting the gross profit that we expect, right? The gross profit less the overhead is a decent profit, is a reason for doing it, So it's understanding those variables. In particular with if you like, the more service-oriented is you're going to have a mix of direct labour, direct staff, and overhead staff. And it's understanding the difference between those. Your direct staff are generating turnover, they're generating profitability. Your overhead staff, you've got to carry. That's an incorrect way of looking at it. But from that cost. Yeah. So it's a question of don't put the horse before the cart, right? Yeah. You really build your direct, and then you build your overhead to support. To build your overhead and then take it to the market is kind of like, I build it and therefore they come. Yeah, it's not certain. Yeah.
Yeah, so same basic principles, but a few things to look at differently. And I guess profit margin, the actual margin. So for us, are my QS team, are they, so obviously the accounting guys and my software developers and stuff are an overhead that we've got to generate enough to be able to cover them. The QS team, you could sort of argue they're a direct cost of the job because you wouldn't be doing the job without them. But because they're salary employees and they're employed, they sort of almost move into the overhead side of it. So our gross return needs to be quite high to make sure we're covering all of those numbers. And I guess it would be same with if you don't have that ability to vary your staff with a lot of service businesses, it would be a similar dynamic.
Yeah, so there is a fundamental change of viewpoint to look at here. Your staff that are delivering direct, the QSing, we could refine based on the situation, but essentially I would say they're direct costs, right? Because it's the responsibility of the organisation to fill them up with sufficient work. It's their responsibility to do the work. And what I mean by that is that you then have ratios and expectations of for every dollar I spend on direct person, I should be able to generate turnover of 2 times, 3 times. And we can look at those types of ratios, and you need to sort of get an idea on what those should be. But that gives you the financial mechanics, right, of that front end. And you need to understand those financial mechanics. You really do. And that's just simply from the point of view of expectation of outcome from staff member. And then you can always swim upstream. If we're not getting the outcome from the staff, which staff member, right? Drill into the timesheets and the workload. Because it's generally going to be a person who's not performing. They don't know the work properly. They don't understand the situation, whatever. Identifying that and adjusting that relationship accordingly, right? Hopefully train them up, get them back into the team, get them performing. But you can then deal with it on a person-by-person basis rather than just looking at it and going, oops, we've made a mistake.
So it sort of comes back to the same sort of fundamentals as a building business, is that, with a building business on a project, you start off with a project budget and you're tracking each month what you've spent, whether it's labour or materials or subcontractors against that budget. With a service business like ours and yours, you've got effectively the budget set by your staff numbers times whatever ratio it is, and then you're looking to track, what have we billed against that budget and then within that, you've got the ability to drill down. And if it's not performing, you can start looking at where those issues are. Yeah. And I guess the same thing in terms of looking at it over time, that you can't look at any particular month. You've got to look at it, what's the plan over time. Yes. And because some months you're going to have good months, other months they're not going to be quite so good. Yep. So being able to average your way through that. But the sort of, I guess, the fundamental dynamics, the things that you're watching, are pretty similar. So I guess the lesson for me out of that is making sure we've got visibility of those things easily in the business so that I can keep an eye on what's going on. So the same as a builder needs to make sure they've got visibility of their progress on a job versus budget.
Yep. And then, it's really just a matter of then drilling down to understand what's going on, right? So, for example, within your business, very similar to an accounting business, in that, we're employing people to crunch things and to provide that service. So I simply spreadsheet out, the number of working days per month. And of course, December, January, terrible.
February's not much better. February's not much better either. Yeah. Short month, holidays.
Yeah. That's right. I'm down to the number of working hours, and then I apply a typical unproductivity type of percentage because, we're not machines.
Yeah.
Now I've got a guide. I've got a guide per person and total per month. So that's my turnover budget. We track every single job. I don't know whether you do or not, but, a typical QSing job, you might have a different pricing structure for different size jobs. You come up with a price. You've probably got a budgeted number of hours to achieve that. Yep. So you can then question that, is the staff member performing? Is this a consistent problem? Is the budget right?
Yeah.
Yep. And you simply iterate your knowledge backwards and forwards, and you refine your knowledge about your business within your industry, You can go out, more difficult for you because not many people are operating QSing the way that you're operating. But, we can compare our prices to other accounting firms and get a real close understanding.
Yeah.
You're competing against a different delivery mechanism, and then it's a question of whether, you've got better price or better quality, better, all of these other value adds.
Our biggest competition is probably, a builder or somebody doing it themselves with an Excel spreadsheet. So it's sort of, so there's other QS practices, but I think the research is about 70% of companies do it themselves.
So I've seen some pretty gnarly Excel spreadsheets, right?
Yeah.
And the real problem becomes when you're the customer who's, customer facing a markup based on an Excel spreadsheet that just misses pages and pages of important dollar values, right?
Yeah.
Or if you're the builder and your Excel spreadsheet and you're signing up for a fixed price contract and you've missed a whole pile, it happens. And that's dangerous. Somebody wears it. As a business, you just don't want to expose your business to that.
Yeah.
So, we have, most of our clients use the likes of Xero. It's a great accounting program. There's a whole pile of add-ons available for project management, specialising for the building industry and what have you.
Right.
And you keep it simple, so that you're not paralysis by analysis. You're not employing a full-time clerk to put in all this data. And that's a dance that can be done with the accountant and the builder, right? Hey, look, what do I need to track in order to get what I want from my business? Well, what do you want to know from your business? Let's have a conversation, because of course in that area, the builder doesn't necessarily know what information he can access. Whereas the accountant is really they think quite laterally, what knowledge is available and how we can put this information with this information and create an interesting statistic to follow.
So talking about following things, so is it good enough to just follow your bank account? How much of an indication does your bank account give you as to how your business is going? I guess what I'm asking about is cash flow. So that's the other sort of leg to this whole thing is cash flow, that you can be profitable. And sort of looking at, we touched a bit about the boom bust in the industry, that from what I've seen, businesses tend to go under on the up and on the down of the bus. They don't tend to go under in the middle or the bottom. So it's the change. Yeah. So so how important is cash flow, and how do you make sure you're keeping track of that?
Well, cash flow is really important, right? But you've got to understand where cash flow comes from. So cash flow is essentially, the cash from your turnover less the cash to your expenses. So if you're not making profit, your cash flow is foundationed in a problem. It's going to catch up with you. So the first thing is got to be profitable. With change, what happens is businesses can fail due to their success, right? So that's called over trading in accounting. So all of a sudden we just exploded, and we've woken up to the realization that we've got $1 million worth of inventory and people owe us $2 million and we can't pay our wages, and this is just stupid. Well, that's typical over trading. And the key thing there is that banks tend to support profitable businesses that have cash flow issues. They don't support unprofitable businesses that have cash flow issues, right? So if you know that you're profitable and you're in trouble, get in front of your bank. So that's where you kind of move to a much higher trading situation.
So just picking up out of that, so the difference between profit and cash flow, I guess, is time. Is that you might be making a profit, but if the cash hasn't come in, the expenses may be going out and you've got some money that's due, and if it's not coming in time, then you're running out of money, even though you're profitable. And I guess that's why businesses often fail on the upswing, is that they're suddenly having to buy more from the merchant, buy more materials, but they haven't been able to bill it yet, or they've got to hit deliverables before they can get the money in. And your bank account doesn't tell you that. The bank account just tells you now.
Exactly. Yeah. And, maybe you're trading really well, but, you don't have that money in. Now you can't pay your main supplier. You lose face with them. You lose, they don't trust you anymore. So a profitable business then loses, or they increase margins to, you're risky. And the inverse then, right? So the inverse is, the market's handbraked on, but I've got a whole pile of receivables and I've got my, I'm just finishing off this job, cash has come in, everything's fine. Let's just sit back and ride it out, right? Cash flow's fine. We get to the point where we've exhausted our cash flow, and then we realise we should have let go 2 staff 6 months before. We should have sold some gear. So we've been living in this false sense of the cash that's come out of history and doesn't get us through. So either way, change creates uncertainty
and creates risk. And the key, I guess, is tracking not only at the project level, but I guess at the business level, and having that underlying business plan or business strategy, so where you expect to be and can understand if you're off, and if you're off, then you start talking to people about it.
That's right. Business is not certain, so there's going to be off moments, right? And it's then understanding those off moments and understanding how to navigate through them, whether that's short-term funding from yourself, from the bank, or rejigging things, factoring a debtor to get you through. Don't tend to like selling off plant and equipment unless you really, really need to, or if it's
because you're obviously reducing your capability.
You find this is one of the things, right? Business and accounting is logical. Some people think, it's all mystique, and where do they come up with these numbers? It's all logic. So if you're in the middle of a problem, there's a logical understanding of it, which means there's either a logical solution to it or shut the door.
Right? That may be the logical solution.
That may well be the logical solution. Absolutely, yeah. And so let's just cover that one off, right? Shutting the doors early is much more important than shutting them late, right? Because if you know it's going pear-shaped and you're just running it into the ground, you can be pulled up for contributing to its insolvency, right? Because if a business gets handed over to a liquidator, you've lost control completely. And the liquidator's looking to do the right thing. You know, if the owner's made a mistake, they're going to look to try and recover from the owner. So, yeah, that's where the director responsibility kicks in and things start to get a bit sharp, you know. But again, there are advisors to guide. Yeah, just don't bury your head, right?
Yeah.
That's what we do. We do, don't we?
Yeah. Yeah, sometimes, you don't. Xero, you run the profit and loss, and do I want to?
Don't do it on Friday because it ruins the weekend.
Yeah. So, Tim, thanks for your time. Thanks for all the free accounting advice. Is there anything else, any burning issues or anything else you'd like to raise that we haven't covered so far?
For the industry, I think we kind of covered things, I think the burning aspects really are every business is unique. Every owner is unique, right? We're not to be out there trying to build a business that's designed around somebody else's ideas. So get in touch with your own ideas and your own sense of what you want. Get in touch with your advisors to see whether or not that's in any way logical, right? You got to watch the accountants because they can be a bit conservative, a bit risk averse. But you will find the ones that are that will help you through the dream or into the dream, and that's what it's about. It's about dream. It's about, to me, very much. It's about finding your freedom, your growth, your joy in your business, not just on the weekend when you get home from your business. All right. If you've got to spend the weekend recovering from the stress of the business,
Yeah.
Oh,
that's great, Tim. Thanks for your time and thanks for the reminder about, I'm in the business to enjoy it. Sometimes the grind can definitely get on top of you. So thanks everybody for listening in. So I'm Nick Clements from YourQS. If you want to deal with a QS that really understands the complexities and the difficulties in the building industry and looks to try and help you make sure you cover them, then give us a yell. If you want to deal with an accountant that really understands business and is passionate about wanting to make you succeed and help you succeed in your business, then Tim's a good place to start.